Hello everyone, welcome to The Plain Bagel. I'm your host Richard Coffin. We're taking a break from covering this channel's favorite topic of tariffs to cover our second favorite T-word topic, Treasury bonds. Now I know you're probably on the edge of your seat struggling to contain your excitement, but please be seated, settle down if you can. Because in fact our discussion today is quite dire and serious, according to many on Twitter, with many people ringing the alarm bells over US Treasury bonds recently and warning others to call their mom, their mother's aunt twice removed, Mother Mary of Bethlehem, because the bond market as we know it is falling apart. According to Twitter anyway. As for why people are seemingly getting so spooked here, the short of it is that this past couple of weeks, we've seen the 20-year and the 30-year US Treasury bond yield, meaning the rate these instruments pay relative to their price, both reach above 5%, nearly surpassing the 18-year highs seen in 2023 before settling lower. Meaning not only that US Treasury bonds, considered by many as one of the safest assets out there, are selling off, but also meaning that the US government is seeing its cost of borrowing increased quite substantially. And it's been accompanied, if not caused, by a number of concerning updates, including recently the downgrading of the US credit rating by Moody's, a lackluster 20-year bond auction, and a similar jump in treasury yields in Japan, where 40-year treasury bonds reached their highest yield on record, albeit at under 4%. Something that some fear could translate into another sell-off event for US markets, similar to what happened last August. And as we typically see with these sort of negative updates, people have really run with these headlines and perhaps gone with some over-the-top posts over the impending collapse of the United States. And to be clear, there are a lot of real risks arising from the situation. But as is usually the case, there's also a lot of nuance that show that yes, while this is something worth monitoring, it perhaps doesn't warrant the alarmism we've seen online. So today I'll try to explain what exactly is happening with the US Treasury bond market, why it matters for those who don't understand what these auctions and factors mean for actual investors and the economy, and try to put things into perspective without the sort of alarmist rhetoric. And I know that I've sort of covered this topic in passing in many of my past tariff videos, given that treasury bonds have been impacted by the ongoing trade war. But given that the topic isn't inherently beginner friendly, and we have a lot of these sort of fire and brimstone posts circulating, I figured it deserved a dedicated video to really address the anxieties, given that this type of content can really spook individuals, and especially given how complicated it can get at times. So I figured it was worth revisiting and focusing in to try and clear things up. But before hopping into the recent updates, let's start with a quick primer on treasuries and yields and why they even matter for the uninitiated. If this is something that you're well familiar with, you can use the timestamps in the description down below to skip this section. As most people are aware, treasury bonds are an investment instrument that allow people to lend money to the government, in this case the US government, for a specified interest payment and a specified period of time. When we talk about a 10, 20, or 30-year treasury bond, that's how long the loan is outstanding, after which you get the face value back. And because the US government spends more each year than it brings in with taxes, it sells or issues these treasury bonds to raise money to make up that difference. Now, the actual interest rate that the government pays on these loans is generally a factor of demand for the bonds. There are other sort of factors that matter, like the Federal Reserve and its own interventions. But generally speaking, the more that people want to invest in US Treasury bonds, the lower the interest rate that the government will ultimately have to pay on new issuances. And over the last decade, the average interest rate that the government has paid on these bonds has been fairly low, with the average interest rate paid falling below 3% from 2011 to 2023. And part of that is because these instruments are generally considered very low risk. In fact, some models even assume that they are risk-free, the sort of lowest amount of risk you can take on when investing in the US market. However, recently we've seen treasury yields for the 10, 20, and 30-year treasury bond, which ultimately determines the interest rate paid on new debt issuances from the government, increased quite a bit, with the 20-year yield specifically rising nearly 70 basis points from its lowest close to its highest in just around a month and a half, which generally indicates lower bond demand from investors. Yield is a function of how much a bond pays relative to its price. So as the market price decreases, indicative again of lower demand, the yield, and as a result, the interest rate on new government issues, increases as a result. And frankly, the increase in this interest rate that the government now has to pay on its bonds to attract enough money from investors comes at a pretty bad time, because in 2025, in addition to new government borrowing from recently announced budgets, the government actually needs to refinance a whopping $9.2 trillion, or just shy of a third of its total outstanding debt. Meaning that suddenly, given how low interest rates have been in the past, the government's going to be paying a lot more in interest on even just its outstanding debt. And as you can imagine, that comes with a number of implications. But why are yields on the rise in the first place? Well, part of it is the fact that the Federal Reserve, the US central bank, has maintained a high federal funds rate since after the pandemic, when it first hiked interest rates to combat inflation. And while the higher interest rate policy from the central bank has been pretty successful in bringing down inflation rates in the US economy, with the current US trade war expected to increase inflation once again, we've seen the Federal Reserve Chair Jerome Powell express caution in cutting rates until we see more stability from US trade policy. So with markets seeing how volatile the trade situation is, and that in general also increasing the risk around these treasury bonds, that could in part be why we're seeing treasury yields increase as markets are pricing in a delay of rate cuts and this heightened volatility. But in terms of what's caused the more acute short-term increase just over the past 2 weeks, where we saw the 20 and 30-year treasury yield reach above 5%, that's generally being attributed to three main factors. Firstly, as we mentioned in the introduction, on Friday, May 16th, we saw the US have its credit rating downgraded. In the US, there are three primary credit rating agencies, Fitch Ratings, S&P, and Moody's, who rate bonds and fixed income instruments for governments and different corporations based on their perceived risk. They do the analysis to determine how risky different borrowers are. And on May 16th, we saw Moody's decrease America's Treasury bond rating from AAA, or the highest level, to AA1, making it the last of the three agencies to downgrade America's rating from the highest level. As for why Moody's downgraded the US, they essentially view the country's current spending trajectory as being unsustainable, with costs on the rise and revenues from taxes expected to stay flat. With the higher refinancing costs for US government debt actually being a key contributor here, with interest expense alone, which represented just 9% of total US revenue in 2021, expected to rise from 18% of revenue in 2024 to 30% by 2035, or 10 years from now. Meaning that by 2035, Moody's expects nearly a third of total US tax revenue to go just towards servicing US government debt, with interest already being one of the largest expense items on the federal budget, even topping defense and Medicaid. Moody's also estimates that the federal deficit will reach nearly 9% of GDP by 2035 versus 6.4% in 2024, and that debt to GDP will rise to 134% versus 98% in 2024. All of which, as you can imagine, bond investors didn't take too kindly. Not only because the higher deficits mean that the government will continue to increase the supply of treasury bonds in the market, but because with the higher perceived risk around US debt, given the credit rating downgrade, investors are now demanding a higher return for holding this investment. So that was one of the headlines driving the increase in treasury yields over the past couple of weeks. The second reason, which was actually cited in this Moody's downgrade, is the government's budget, the so-called One Big Beautiful Bill Act, which is not just what Donald Trump calls it, that's the legal name of this bill, which we got the update last week that the House of Representatives had actually passed this bill. And while considered a Republican bill, it's far from fiscally conservative, with the bill actually estimated to add $4 trillion to the US debt load over the next decade. As for what measures are explicitly in the bill, naturally, there's a lot more than I can cover in passing in this video. The bill itself is over 1,000 pages, but includes everything from a $25 billion Golden Dome missile defense system to a new type of savings account formerly called the Mega account, now called the Trump account, that will be providing $1,000 for newborns. And there are some spending cuts and tax increases to try and offset the other tax cuts and spending initiatives in this bill. For example, the bill includes lower spending on food aid and Medicaid, with eligibility criteria being tightened for both programs, something that the CBO estimates will cut 7.6 million people from Medicaid. And there's $330 billion alone expected to come from restructuring around how student loans are repaid. However, these spending cuts, which have generally been geared towards lower income programs and benefits, are not expected to offset the other costs of the bill and tax reductions, which have also been controversial given that they provide the biggest benefit to higher income tax brackets. Now, despite being approved by the House of Representatives, the bill is expected to change further as it goes through the Senate, which, despite being a Republican majority, is expected to make further revisions to further reduce the deficits. But naturally, this update that we'd see this widening of the budget deficit was negative news for Treasury yields. Now, the third and final short-term factor contributing to higher Treasury yields that some might actually highlight as the most acute factor here, given that we saw Treasury yields peak on the same day as this update, was the news of a quote, lackluster 20-year Treasury bond auction this past Wednesday. You see, when the US Treasury Department goes to issue new bonds, it typically does so through an auction where investors, usually institutions, can actually bid whatever yields they're willing to buy the bonds for, with the government then issuing bonds from basically lowest yield and upwards to raise as much money as it needs. And this past week, in an auction for $16 billion of new 20-year bonds, the government saw itself reaching for yields as high as 5.046% in order to complete the sale, which was quite a bit higher than the previous 4.81% paid in the previous $13 billion auction held last month, and the average interest rate of 4.613 paid over the last 6 auctions. With the auction not only directly increasing the yield for 20-year treasuries, given that these bonds were being issued at a higher rate, but also further deteriorating the sentiment around US Treasury bonds and demonstrating a decreasing appetite from investors for US Treasuries. Now, there are some who have speculated that other countries have actively played a role in the Treasury sell-off, with some specifically claiming that Japan, the largest foreign holder of US Treasuries, has been selling off hundreds of billions of dollars worth of their trillion-dollar stockpile, either in retaliation to US trade policy or as a result of some carry trade unwinding related to their own bond market woes. So far, though, we haven't had any official figures to back up these claims. And in fact, some experts have cast doubt on the idea that Japan has meaningfully reduced its treasury holdings, so it doesn't at this point appear to be a material factor. So that's why we saw treasury yields spike this past week. As for why it matters and why we're seeing people raise the alarm bells over all this, generally speaking, treasury yields are sort of gravity on the market. The higher they rise, the more pressure there is on economic activity. Not just because the government might have to eventually pursue more austerity measures, decreasing spending or increasing taxes to try and offset this higher cost of borrowing money, but because these treasury yields are a benchmark for other interest rates in the economy, and as interest rates increase, they generally discourage spending in an economy. For example, we recently saw mortgage rates in the US economy rise to nearly 7%, something that, as you can imagine, makes it harder to buy a house. It also increases the risk of defaults in the economy as people have to refinance into more expensive loans. And as treasury yields increase, they can also apply pressure to stock markets, not only because the companies themselves are, again, seeing higher interest rates, but because it actually reduces the attractiveness of stocks relative to treasury bonds, which are now offering a higher, again, technically risk-free rate for investors. But one of the more obscure risk factors that, as mentioned, is raising a lot of hoopla online is the risk around the balance sheet of financial institutions, which are taking a hit as a result of rising treasury yields, and have many worried that we're approaching a situation similar to what led to the collapse of Silicon Valley Bank back in 2023. You see, US banks hold a significant portion of their assets in long-term fixed income securities, things like mortgage-backed securities and US Treasury bonds, many of which were acquired during periods of rock-bottom interest rates following the financial crisis of 2008. However, because these assets pay a low interest rate, and we see mortgages and treasury bonds now paying a higher interest rate, they've actually become less valuable, and we've seen their market price decrease, with banks now sitting on nearly $500 billion of these unrealized losses, with a good chunk of these securities being classified in a way that prevents these losses from showing up in the bank's income statements. Meaning that if these banks were forced to sell these assets, they would lose hundreds of billions of dollars. So yeah, you can see why there are a lot of concerns around rising treasury yields and why they matter more beyond just, the cost of government borrowing is on the rise. So what does this mean? Are we truly on the cusp of another financial crisis in the United States of America? Well, maybe, but probably not. Don't get me wrong, there's certainly risks at play here and concerns around the sustainability of US government debt, and we could certainly be entering a recession or slowdown as a result of these risks and factors. But there are a few reasons why this isn't a repeat of the 2008 financial crisis or the Silicon Valley Bank collapse of 2023. For one, as we sort of alluded to in the intro, this isn't the first time we've had higher treasury yields in the United States, even over the past few years. For example, there was a lot of the same alarm and even online posts when the 10-year treasury yield peaked not that long ago, much of which didn't lead to any sort of tangible decline in the economy. And even with this run up, the 20 and 30-year yields have stayed below their 18-year highs set in 2023. I know this graph doesn't make it look like that, but that's just because some dates end up missing when you zoom out. So just the first thing worth noting here. People tend to exaggerate these risks and really suck at predicting the next crisis. Secondly, around the US credit rating downgrade, it's worth noting that America's AA1 credit rating is still a very high rating. That's in line or higher than 4 of the other G7 nations, with only Canada and Germany maintaining a AAA rating among the group at Moody's. In fact, in the credit rating update, Moody's actually upgraded the country's credit rating outlook to stable, with the agency noting a number of key strengths working in the US's favor, including the country's size, resilience and dynamism of its economy, the role of the US dollar as a global reserve currency, and the independence of the Federal Reserve and separation of the branches of government. Which, while yes, there's been kind of some more recent concerns around those separations, Moody's expects the strength of the system to stay in place and expects the US economy to continue growing in the long term. Thirdly, on the note of financial institutions, outside the fact that the institutions and government bodies have since reacted to the Silicon Valley Bank collapse, it's worth noting that many large banks have significant derivative contracts that are specifically geared towards managing the risk of rising interest rates. This was something that actually turned out was a severe blind spot of Silicon Valley Bank, which had very minimal risk management around rising interest rates. While many banks have trillions of dollars in notional value for these derivative contracts geared just towards managing interest rate risk, Silicon Valley Bank had just hundreds of millions in notional value of these hedging contracts versus their hundreds of billions in deposits. On top of that, a big part of the Silicon Valley Bank collapse was the fact that it experienced a bank run, something that, while a risk for more regional banks, is much less likely to occur for a larger bank like, say, JP Morgan or Bank of America. Not to mention that, as this graph shows, the loss on the balance sheets of these banks is still less than it was back 2 years ago. So yes, there is pressure on the balance sheet of financial institutions, but there are also offsetting factors worth considering. Financial institutions also typically make more money when interest rates are higher, which you can actually see in the financial filings of banks like JP Morgan, where they disclose their interest rate risk and show that they actually expect their earnings to increase in scenarios of rising rates. And if you want to dive further into it, I actually made a video comparing the financial health of the large US banks shortly after the Silicon Valley Bank collapse, where I dive deeper into the figures. Naturally, it's going to be a couple years old, but you can go there if you want kind of more details around the actual risk faced by financial institutions here. Fourthly, while there are concerns around the unsustainable path that US government debt is following, it is worth noting there that one, there are many other developed nations that have larger debt to GDP ratios than the US government and don't have the same benefits as, say, a global reserve currency and supportive economy. And two, since the 2008 financial crisis, while government debt has been on the rise, household debt has actually been on the decline, with household debt as a percentage of GDP dropping roughly 6 percentage points since 2022 and down meaningfully from the financial crisis, which does position the economy better to digest higher interest rates. And finally, it is worth noting that the Federal Reserve does have a number of levers it could pull to intervene if things truly approached critical levels. Yes, there are rate cuts that the central bank could carry out, but there's also things like quantitative easing, whereby the Federal Reserve would directly buy bonds to help lower long-term treasury yields, something it hasn't actually done since the pandemic, with the balance sheet for the central bank slowly decreasing since then. Now, of course, it's not to say there would be no implications to this sort of intervention. Inflation is a big one that needs to be considered here. However, it is to highlight that there are many different players and factors here that are going to ultimately impact how things play out in the short term, and it's near impossible to predict how each of these variables is ultimately going to change and impact the economy as a whole. Which is why it's incredibly crude to look at things like the 20 and 30-year treasury yield and extrapolate a crisis from them. Yes, they are negative updates when taken in isolation, but these factors don't exist in isolation. And the goal here isn't to downplay the real risks that exist here, especially around trade policy. I know I said we weren't talking about tariffs, but they do play a role here, especially with things like American protectionism. If that's something that we see reinforced over time, that is something that's going to impact treasury bond demand and the cost of borrowing for the US government. The more isolated the US makes itself from the world economy, the less demand there's going to be for the US dollar and US treasury bonds, and that's going to impact who they can raise money from. But if nothing else, hopefully this helps to offset the more extreme and alarmist posts out there and subside some of the more intense fears that things are on the cusp of another 2008 collapse or Silicon Valley Bank event. Yes, there are certainly risks at play here, but things tend to be a lot more slow moving than social media accounts tend to give credit to. And by next week, we're going to have a different crisis or huge positive turnaround that's going to dominate headlines. So it's important not to put too much stock in these sort of alarmist posts, and we'll just have to wait and see how things turn out. Thanks for watching. I hope you found this video helpful. If you did, please do make sure to like, subscribe, all that good stuff. It does help the channel tremendously. And let me know your thoughts on the Treasury story. I know a good chunk of you are thinking, Richard, I subscribe strictly for tariff content. What are you doing talking about the bond market? And I apologize for depriving you of the latest updates around trade and tariffs. But I figured it was something worth diving into. I know these types of stories and headlines, especially given how obscure the area can be, can induce a lot of anxiety from investors, especially those who might not have that degree of understanding. So I figured it deserved a dedicated video, even again, with us sort of touching on the topic here and there. Thanks again for watching, and as always, be safe out there.